Welcome back to the Funding Blueprint. We have an exciting and insightful guest with us, Howard Finkelstein, a seasoned corporate and finance lawyer with over 25 years of experience at some of the country's largest firms, representing major financial institutions and multinationals. In 2009, Howard shifted gears to start his own practice, focusing on helping small and developing businesses, particularly startups, navigate the complexities of the modern business world. However, Howard's innovative approach involves being deeply involved with his clients, providing daily legal and business advice to help them make sense of the chaotic startup environment. Unlike traditional lawyers, he avoids hourly billing, preferring retainers, and always looks for ways to help his clients execute their plans. Howard's firm, HJF Law, has grown steadily with a team of young lawyers who share his vision of partnering with startups to drive their success. They have embraced the informalities of the startup world, focusing on effective communication and collaboration through modern means like Zoom and Slack. Get ready for an engaging discussion with Howard as we delve deep into the world of startup law and his firm's unique approach to supporting emerging businesses. Howard, welcome to the show.
Thank you. Good to be here.
Of course, happy to have you on. So before we kind of dig deep into the specific questions that we have rolled out here for today, let's talk about HJF Law. Share a little bit more about that and what value it brings to its clients.
So as you said, I spent a long time working for big firms, big and like super big and medium and big, whatever style they are, and they do a very good job doing certain things. They do a very good job representing big companies. They do a very good job even representing small companies, except that there's a problem there that they don't give small companies the level of attention that they really need. And that's really a question. It boils down to a question of money, and so therefore, one of the first experiences I had when I left the big firm, and I brought along a small client with me, and and I was at that time still charging billable hours as they did in the firms, and they had a big crisis, and like a week later, they told me they had this crisis. I said, well, why didn't you call me? They said, well, we didn't want to have to spend an hour of your time to and pay you for it. I said, but look what you lost out on because you could have had my advice during this week. So it was I decided that we've got to get rid of the billable hour, and that was goal number one. And we basically have, because we represent all our clients, just about all our clients, on a subscription basis. We set a fee, a monthly fee for a year or sometimes even longer, and we do whatever's necessary for them during each month, and as the contract goes on. And sometimes I get the better of the bargain, sometimes they get the better of the bargain. It works out. And what they get for it is they get our full body and soul, because we know that it's our role to get them to where they need to be. Nobody else is right. We're not putting it off on anybody else. We're not going to drop them because they can't pay a bill. We're not going to say that's all you have. It's all the time you have. We're just unlimited. It's all you can eat, basically. And that's what we do with our clients. And they seem to be happy. Most of them are. I think the ones that stay are. And some people, maybe need more. I don't know, but it's and it's a very. I mean, the whole idea of the billable hour is, in my mind, is it's like an evil institution. It's bad for clients, and it's bad for lawyers too, because you see lawyers going crazy with their hours. They only focus on their hours. And I mean, I had a very good friend who also works with small businesses, and they decided to go to the system where they will give a set fee for a particular document, say a merger agreement. But they say, oh, by the way, this is a simple merger. If you have IP in the merger, we charge $10,000 extra. If you charge this, we charge that more. So I said, that's not really client friendly, is it? You're not encouraging them to grow. And our attitude is that we always grow with our clients. Their success is our success, not vice versa.
I like that approach a lot. I think it's a lot easier to work that way with clients, and just in general, I think our community will like that as well. So we'll definitely at the end of the show kind of mention more of where you can learn more about Howard and the impactful work that he's doing. But thanks for sharing. Let's kind of dive deep into the real meat of the conversation. Let's talk about the term sheet first. Term sheets are the foundation of your funding agreements, right? They outline the key terms of the investment. But here's the thing, Howard. These documents aren't always a one size fits all, right? While consistency is desirable, there's different investors might have their own unique priorities and their own preferred terms. This can lead to variations in your term sheets. The question is, how do we navigate these variations? And is it crucial for every investor to have identical documents, or can there be some flexibility?
Right. So certainly the first question, can you make individual variations for particular deals for the whole deal? The answer is yes, with a but. The but is that, sometimes, let's say you're doing a seed round, right, which is before a Series A round where the big guys come in. You're doing a seed round, and somebody says to me, I want XYZ in the seed round, which is never done. And I'm going to turn to them and say, look, it sounds fine to me as a business proposition, but you know what? These Series A people are going to come in and they're going to look at this deal and they're going to say, you're not our type of guy if you've given your investors this kind of deal. And so that, and it happens, it really does happen. They do diligence before they even start about deal terms. They look at the previous deals and they see what it's like. And sometimes they get an impression that this is not these people sort of do whatever is non-standard, And as you graduate through the cycles, where you get VCs involved, they really want more or less cookie cutters. I mean, yeah, fine, $1 billion deals, they don't care if it's cookie cutter or not, but the average startup deal, they really want cookie cutters. They don't want to have to pay too much attention to all that. So, but then the second level, in terms of individual variations within a deal, it's a very interesting subject. And we've seen, it used to be back when I started, you did a deal, everybody sat in the closing room, they all signed the documents, they all delivered the money at the same time, everything was exactly the same. But fortunately, I think because I mean I like this economy. I like the fact that people are remote and they don't have to get together and sit in a room, and they don't have to have every closing at the same time. And so you could actually extend your financing over months and even like a year or two. As you need more money, you put out another instrument. And it works for convertible notes, it works for safes, it works for the early stage instruments where you can be very flexible and you can change your terms as you go along. And with the safe particularly, you really, if you stick with the safe for a long time, the founder is going to be giving away a lot of his equity because you do it at a low valuation, and when the safe gets converted into stock, you're going to be giving the investors a lot of equity. So it's really convenient as the company, if the company has the ability, and I've counseled a bunch of clients to do this, as you get the ability to raise more money, do it then. Just don't do it now. And instead of if he's going to say, I'm going to need $1 million to get through the next year. Well, why don't you raise half of it now with the lowest valuation? Then you're going to start having sales. You're going to have to start having a reputation. You could raise the valuation, and people do that. I mean, I have a client that went from in the course of about a year, they I can't even figure it out. They raised their valuation by 500x, because they did well in the process of the year. So the last people who came in were very happy to invest because they were investing in something that was really hot, you know. And even though they didn't get as much equity as the first people, they were very happy to do it. And this way, the company didn't have to get all their eggs in one basket. So yeah, and that's happening a lot more often now than it used to happen.
Cool. Let's talk about fundraising for a second. There's two really interesting approaches that I want to tackle here. Imagine you're fundraising as a play. You've assembled a stellar cast of investors, but how do you actually orchestrate the closing, right? This is where there's two different types of approaches. One is the single, dramatic, one big bang, closing with all investors on board, or a staged approach with smaller closings and phases. Each has its own advantages and disadvantages, and the best choice depends on your specific situation. So the question is, what factors should you consider when deciding between a one-time closing and a staged approach?
Good question. It's sort of a lot of what I said earlier, and that is that if you perceive that your valuation is going to be going up really sharply up over a short period of time, you should do that staged closing. You do every 6 months, and obviously once you're in the Series A or higher rounds, you really probably need some unity in the closing, but make small closings. You don't have to be in the highlight of the lead story in the newspaper. What you have to do is raise enough money to make it to the next round and not give away as little founder equity as you have to, you know. You could, I mean, people do that, but people, again, obviously, a lot of people like to just get that taken care of and move on to the next thing. And I could see the reason for it. And if you're confident in the long term, it's fine, you know.
No, great points. We've mentioned a lot about fundraising and particularly term sheets. Let's actually talk about how do we actually find investors now, right? Because that's a hassle within itself.
That is the eternal mystery. That's the secret of all secrets. It's it's not. And you know what? There are two things that um, well, there are a lot of principles that I've learned. And let me say this. When I first started doing this, I figured, hey, I'm a lawyer, but I could also introduce my clients to potential investors. And I found myself spending more time on the second activity than the first activity. And it's really, a lawyer has an inherent conflict when it's pushing its own clients' equity or whatever it is. And trying to find prospective investors is very time consuming. It should be time consuming, and it should be something that you're involved in, but not for me. So, but I mean, essentially, I tell my clients that you have to be at their fundraising day one. You have to make contacts, a million contacts, because a million contacts will get you three investors, maybe. You know, and you have to try to figure out the other point is that there are very few investors out there that will invest in an industry or a business format that they're not really more involved in. In other words, if somebody's involved in crypto, they're not going to invest in a furniture manufacturing company. Even though the furniture manufacturing company is good, because they don't know the industry, they don't know what to look for, they don't know what to do for an exit, if they need help along the way. So it's really very important to think think through who are the people who would be interested in it. You look for competing businesses and try to go through the sheets and say who who's issued capital in this industry, or something that's adjacent to it, or something that's like it, or something that involves the same skills. And you say, I'm going to go after these people. I'm going to find out who invested in XYZ Corporation's C brand, and I'm going to start a relationship with them. And that is the ideal way to do it. You find the people who are in that sector, and you chase them relentlessly. And I'll give you an example. I mean, way back when I used to work with a company, startup that, they had a great, brilliant idea. It was way ahead of its time, and the CEO spent all his time fundraising, and we had a weekly call Monday morning every week, and he would go through all the people he went and saw about this startup, and at the end of every summary, he said, and they thought it was a great idea. And then I realized, like, months down the road, that all these people who think that it's a great idea, they never invested. So that's another thing that you have to do. When somebody says that's a great idea, you say, okay, fine, where's your check? You know, you don't walk out of that room until you get a check. And a lot of people, by the way, say it's a great idea just to get rid of the guy. It's nicer to say it's a great idea than it's a lousy idea. and it's just so it's just being polite. So but the real thing is you have to be very aggressive. You really have to be aggressive. We have one client who, he issued safes, and he would go to conferences with blank safes, and he said, "Okay, fine, you like my idea? Sign here, $50,000, $100,000, whatever the investment is, sign here, and you're in the money. You're in the deal." And that's really that directness is really, and it really makes an impression. It's not just that you get the deal done. You're saying to these people they really want to do this. They're really motivated, and they really have the guts to go follow through.
For sure, for sure. So it's all about execution. It's all about having actions speak louder than words. That's what matters. There are a lot of people that can talk about certain things, but it's another thing doing it. So that's really the key. So yeah, 100%. That aggressiveness is key, I think.
And the other thing is, I just want to say that there are a lot of incubators and accelerators, and some of them really stink. They charge you money to join, and then they give you the whole spiel about what you're doing and everything. But some of them are really good, and they really do make very good introductions. And you like, for instance, Y Combinator is maybe the most best known, and every one of the companies that graduate that program really does very, very well. And it's hard to get in, but so I really recommend a lot of the startups who don't have that context. A lot of people, sometimes some people come from foreign countries. They set up a business in America, and I said go join an incubator and really leave it up to them to introduce you to people.
Right. Yeah, no, it's a part of the whole thing. It's a part of the whole package that you're signing up for. You're getting mentorship, you're getting resources and networking. So yeah, 100%. Many founders unfortunately underutilize that, and many founders don't even look at that as an option. But I think that they should, is because that's the support system, that's the foundation. And these individuals, their whole purpose, the whole purpose of an accelerator incubator is to really help you thrive and build out your foundation so you can at least get the vehicle working a little bit. That's really the purpose of why they're here. So to not utilize them would be really a mistake. But I couldn't agree more with you on that. I want to dig deep into dilution now for a second. We spoke a lot about finding investors, term sheets, fundraising, but let's actually, what happens when you actually fundraise, right? Let's talk about dilution in particular. So, imagine your startup as a kingdom, right, that you've built from the ground up. With each round of fundraising, you bring on new allies to help your kingdom flourish, which is investors. However, each ally takes a share of that decision-making process, which is called dilution. While dilution is inevitable, right? Everyone's going to go through it. Howard, the key is really finding the right balance, right? You need the resources to expand your kingdom, but you also want to maintain control over its future. So the question is, what strategies can you employ to negotiate terms that protect your ownership percentage while securing valuable allies for your growing company?
It's a tough thing, it really is. And a lot of people start out with the premise, I'm going to give up, in my seed round, I'm going to give up X% of the company. And then Series A, I'm going to give up X% of the company. And I'm never, no matter how many rounds I do, I'm never going to go below a certain percentage of the company that I own. And it's a nice idea, but when you're faced with the question of, are you going to pay me bills or not? It's pretty silly to make it off a formula, to make that decision off the formula. So, and again, there's really, one of my teachers who taught me a lot about equity said, and I'm sure it's not very original, but it's better to have a small piece of a big pie than a bigger piece of a small pie. And it really is. I mean, look, but there are also other ways to create equity for yourselves, and with bonuses, with plans, and things like that. That if you're doing well, you could earn more equity, and a lot of people do that, so stock options and things like that. Because nobody, look, if this is a successful company, no investor who's taking advantage, who's making money on that, wants the founder to feel that he's really getting ripped off. I mean, it's one thing when you're not, when you're struggling along, and the investors sort of see the light at the end of the tunnel that I'm not going to make 100x on this deal. Then maybe they get a little selfish. But I think if they see success, they're really not hesitant to reward a quote unquote fair share to a founder who's really good. But the other thing that you mentioned about the decision making power, that's a whole other world, and that is, the difference between sharing the profits, which I think everybody understands that, and sharing the voting power. And, so basically you really have to be careful to allot to yourself a certain share of the voting power that, in other words, I'm one out of five directors, or I'm two out of six directors, whatever it is, then that's going to stay. I don't care how low or high water, that's going to stay. And there are things like the Series F, they call it Series F stock, which comes from Facebook, there where they get 10 votes to each vote that other equity holders get. And I said if you're Facebook, you can get away with that, but most companies can't. It really is turning an eye to that and not relying necessarily on voting, on everybody voting your way is an important thing as you go through this thing. And there are a lot of ways in which you could sort of cut out, section off your voting power, and at least retain what you think is the minimum you need to have control. And one of the things is bringing in outside directors who usually, I mean, not usually, but if you bring in the right outside directors, they will be sympathetic towards management. And I mean, those are interesting games, and a lot of companies never get to the luxury of playing those games. But the fact is that it's important down the road. You certainly don't want to found a company, make it successful, and then being told, by the way, you don't even have to come to the board of directors meetings anymore.
Very true. I think it all starts in the beginning. If you really think about it, just like structuring and strategizing from the very start could really go a very long way. Supposed to coming in blindsided. You have so many support systems, as we talked about, accelerators. You can even get a board of advisors, find individuals that have a particular interest in whatever it is that you're building and have them help you, from a structuring and strategizing perspective. So that's what it all comes down to, is just doing your research and doing your homework in that respect and making sure that you're able to get results, because it all comes back to you at the end of the day. How you do things. Are you diligent? Are you effective? Are you efficient? It's all about structuring. So I couldn't agree more with you on that.
But when you say about planning, wait, I just want to add, I want to add something. When you say about planning, it's a very important thing, and I tell clients, I try to tell clients whenever I remember, and that is, think of the future about these things. Don't try to, don't just get sucked in by what's happening today. And I mean, it's what goes back to one of the principles I have with clients, and that is, I tell them it's never too early to hire a lawyer. That even when even when you form yourself, you have to figure out, like how much stock you want. It sounds crazy then because I'll take one share. No, I'll take two shares. But it's really important to have somebody work with you who has been through these things, and sees what the consequences down the road are.
I agree. I speak with a lot of people and they're like, "What are you talking about? You're not even at the fundraising stage. Why worry about a lawyer now?" I'm like, I don't think that's right. I think you have to get one from the very start. Well, at least until you have an idea of what you're focusing on. You have the right models, the right pricing strategies. Your structures are more or less set up, and I'd say 3 to 6 months away from fundraising, even a tad bit earlier. Try to get an attorney, speak with them. And there's other opportunities. Many firms can even take equity in the company, to my understanding, to decrease the cost of their hourly billing. So there's many ways to go around it. Each firm has their own unique approach, but utilize them from the very start, because I think that that's very, very crucial. Let's talk about, particularly, you got a call with an investor. Right now, what do you do? How do you get their attention? So let's kind of talk about that for a quick sec. Imagine you have just 30 seconds to convince a potential investor why your startup is the next big thing. That's the power of a pitch deck, right? A concise yet impactful presentation that tells your company's story and captures investors' imagination. It's like your elevator pitch on steroids, if you think about it. But what makes a pitch deck truly compelling, right? Here's the million-dollar question. What are the key elements you need to include to grab investor attention and effectively communicate your vision for the future?
Yeah, I tell clients that, I'm a man of words. put thousands of words into action every day, and but the fact is, on a pitch deck, the best thing is to minimize the number of words you use. You have graphs, you have pictures, you have very headlines, but when an investor sees the whole 200 word description of the company, he's given up. There's a guy, I forgot his name now, who has this rule on pitch decks. It's called the 3 second rule. In other words, if an investor is looking at that on a screen, he shouldn't be spending more than 3 seconds on any page in the pitch deck. And it's a great rule. Right. And, because not only that, also the fact is that these investors, the good ones, they've seen all this stuff. You know, they don't need to know your entire resume, the founder's resume, where he went to high school and everything else. They need the basics, and too much is really very detrimental, I think.
Right. So to just summarize what you said, keep things short, sweet, and simple, if you will.
Right, right. And also the one other thing is, don't put anything in there that is obviously questionable. In other words, sometimes you'll have a company that hasn't earned one penny, that doesn't even have a complete product, right? An MVP, and they're talking about their IPO. And I say, wait a minute, you are years away from an IPO. Why would you project that right now? And that's it's really important, because it will turn. It's not that it's not true. Of course, I mean, some companies will have IPOs. It's that an investor will see that and will say, I don't need this guy.